Hey guys, it's Max. Jax is around here somewhere. I don't know if you guys have been watching me for a while, but I used to have a show called Late Night with Max and Jax when I first started, about exactly a year ago, last December and January. There's Jax. Come here, Jackson. You want to say hi? Come here. Come here. Oh, yes. Oh, yes. Good boy. Okay, thank you. I used to have a show called Late Night with Max and Jax, and it was unscripted. Anyway, so I decided to bring it back. All right, let's talk about. But seriously, we're going to talk about the Ultiverse, the Buffer Report, the usual Max stuff, and then I want to go over and talk about an option trade that I recommended today and look a little deeper. So this is Late Night with Max and Jax is for somebody else that wants to look a little deeper. So into options. Let's start though. Now I put a link in my Discord to. I'm trying to get the three profiles under control. I have three profiles, but I have a burner profile that I've shared because I have everything on there that's shareable. And anyway, it's in Discord. So now let's go look at what I put on there. I hope you guys will like it. So what all I did is I made a spreadsheet. I copied from my main spreadsheet that's under my main profile. So I don't want that to get messed up, and I don't want to share everything. I just want to share the Ultigrid, the Ultiverse, the buffer report, the index buffer report, and then maybe a few other things too. But for now, this is a pretty good start. So anyway, we can go the Ultigrid. This is always where I start every day, and this isn't very much to look at. But because I kind of put everything on one sheet, but it does this job. Okay, and I've already done tomorrow's trades, so this could be tomorrow morning's update too. Why didn't it? I wonder why I didn't do it sideways like the other ones did. Anyway, it's fine. Anyway, these are tomorrow's trades, so I went through them. Well, guess what? Jay has dumped NVO. We are out of NVO. Other than that, it looks like the rest of them are still the same. So he closed this one. Sometimes I write out and then make the cell, low, just kind of to notice it or something. All right, so that's good. So then over here is a list of everything. This was their change for today. But you could click on the Ultiverse, and this list right here populates or makes this chart. So this chart is that list. But now tomorrow during the trading day, this will start trading, and these are the positions that are on tomorrow. So if I start doing this at night, maybe that'll make it make it better. But anyway, but you can see everything was down today, and it was not a good day. All right, sheet 4. I don't even know what I have on sheet 4. Oh yeah. That's just a data sheet that I need to run. I need to figure out how to hide that and stuff. Anyway, just ignore the sheet 4 for now. But then we have my famous buffer report. First one is the yield max buffer, which I used to also call single stock buffer. But it's you guys get the picture. The on the left, I should put a legend on here. I used to have one. Left side is the high yield fund. Right side. Red is the parent asset. So when we want blue to be beating red, if blue's on top of red, we love it, but we don't want blue to be beating red on the way down. And it isn't. You can see all on the way down, all of the blues have a buffer, meaning they are not leading on the way down. Outside of YMAX and outside of YMAG, they really don't count because they don't count. But the other ones that are based on single stocks, no, they have a buffer. They are not leading on the way down, which is good. That's what we'd expect. And that's every one of them too. Now, but the trade-off is that they're going to trail a little bit on the way up to. Jackson, please knock it off, buddy. They're going to trail a little bit on the way up too. Look at Murray bouncing back today. It was up 7.8%. My gosh. Anyway, okay. Well, you guys get the picture. Then over here's the index buffer report. But I'm hoping you guys will just look at the link, and I will just update the link every night about 7 or 8 o'clock, and then it'll be good for 24 hours. And all day the next day, if you guys get up in the morning, I haven't had an update yet, or you haven't seen me or don't know what's on, you can click on the thing and at least see what the positions are. You could, if I haven't had an update, you could click on the Altiverse about, 11 o'clock and kind of see what's going on, see what's up, what's down, whatever. And you do the same thing with this. And I really like the index buffer report because these are the ones that I like, although I have some of these also, but I'm just a real sucker for any of these index based ones. Now I like to break down, I'm going to make a separate spreadsheet that breaks down the hedge ratio of Y triple Q to whatever. It could be whatever, but we'll make it QDTE since that's such a popular one and a good one. So I'm going to make a separate sheet, and it will just calculate the running daily hedge ratio, meaning how much Y triple Q would you have to hedge a position in QDTE, or to partially hedge. I'll have some content on it, but anyway, that's something I'm interested in. But just real quick, back at the envelope math, which is one of my favorite things to do. So usually the hedge ratio is 80 to 20 is just a good place to start in my head, just when I'm eyeballing it. So it's real easy to figure out. All you have to figure out is Y triple Q was up 1.3. We'll call it 1.3. Well, you only get 20% of that. Well, 20% of 1.3 is 2.6. So about a quarter point. So you get a quarter point better than, where's QDTE? Wherever QDTE is. It could be any of them. You could use it on, it could be any of them. It could be this one, triple QI. It could be that one. That one's a really good one. It could be this one. This one's a great one. All right. So then, so what do we say? You get a quarter point improvement because of your 20% here, not to mention you only get 80% of this downside. So this is what's that, 1 3/4, and you're going to get 80% of 1 3/4. Just call it 1.5, just to be, I don't know, that's somewhere 1.5, and then minus, call this a quarter point. So you're only down 1 1/4 on a day where if you just had QDTE, you would have actually been down 1 3/4. That's a huge dampener on volatility. I don't like risk. I don't like volatility. Those are the kind of things I like. I'm going to add Y triple Q into the family portfolio soon. I just haven't yet. But also in my own portfolio, I pretty aggressively trade puts and calls. So whenever the market's going down, I load up on SPY puts. So I kind of hedge that way. I don't, anyway. So, but this would, the Y triple Q would be a good companion for a yield max position or a yield max position or a triple QT. But it could work for any of them. Anyway, I'm going to start computing the hedge ratio because you can be over hedged, and I'm going to have some content on it. You can hedge to the extent where you make no money. In fact, where you're just giving money away. So of course we don't want that to happen, but of course you don't want to be under hedged either. You want it to be worth it. But I think the difference between being down 1 3/4 on a bad day and 1 1/4 is pretty good, especially because there's not that much give up because you still get yield from both sides. Okay, so that's my speech on that. So let's talk now about the charts. Let's see what the market's doing. All right, so the market. Gosh, I wish this. These gaps are awesome ways to play indexes, in my opinion. Just really interesting things to look at. Anyway, you can see where kind of or back here, I would have done it. This is a good case for an iron condor. I don't like iron condors, but it doesn't have to be an iron condor. It could be a butterfly. It could be an iron butterfly, or it could just be a butterfly with this. It might be a good place for a non-directional trade. Now that we've gone sideways for a few days, I don't know if that's the case anymore. That's the way I use this gap information. Or if I was already bearish when it got into this gap and failed and then kept falling out of it, that would have been a great place to buy puts. At the same time, if I'm bullish, I can always wait for it to hit a bullish gap and turn around and try some calls there and see if that works. No guarantee it works. Anyway, so we'll keep an eye on the gaps. I do think it's notable this, though. This is the one thing just on a relative strength basis. This the SPY or SPX that's its Trump gap right there. And it's been at a 1, 2, 3 times. It's gap from the Trump night. Well, really, I don't know that the market's not really the Qs. I don't even know why I even look at the SPYs. I look at the Qs a bunch too, but the Qs are so far above their Trump gap. So either which one of them's wrong? Okay. The Qs also got hit that same bearish gap now, but the Qs also have a bullish gap that's still open down here that they're about to sell into, as you can see. Anyway, whatever. When you're in chop, the gaps work and stuff, and when you're in a trending market, they don't respect gaps, but that gives you information also when prior gaps aren't being respected and prior support and resistance isn't. It's all just an additional data point. Okay, so but I think that's interesting how much. To me, I mean, SPX is right here on a relative strength basis, where NASDAQ's right here. The election was right here. NASDAQ is just, a little bit stronger. So, and that makes sense because the tech pros and stuff, and that's all good. So, and I don't know if that's anything to look at, but everyone says the Trump trade was Russell. Okay, well, let's look at Russell. Russell has already fallen through its election night gap. Its election night gap was a gigantic one right here, but it fell right through it a few days later. But it did not hold. So the Russell's there. That tells us the Russell's the weakest of all of them. And in fact, its election night gap is now acting like resistance, which is not a good sign if you're a bull on the Russell. So, of course, the Russell is probably reacting to the notion of higher rates or not higher rates, but not as many rate cuts as fast or whatever, and also that the bonds have been going up lately. The 20 years been going up. Let's look at TLT. So anyway, it's whatever. It's just another data point. But if you believe that bonds and Russell are smart money, then the Qs are way too high. But if you believe the Qs are the smart money, then the bonds then the Russell especially is too low and needs to turn around. Something needs to give. All right. So yeah, but TLT, let's get a longer chart on this on TLT and see. Now, on the longer term chart, it's kind of ranging and it's right about towards the bottom of its range. The TLT is probably a buy around here. I don't know, but just on a mean reversion basis, possibly would have been a good sell when it got above the upper Bollinger up here. But hindsight's 2020. It's easy in hindsight. But by the same token, if it messes around down here and can't get traction and then gets back inside, it's probably a good bet to go back the other way. All right. So what else can we look at? All right. So let's talk about, so I had content on a 3-legged option trade today, and I got a question about it. So loaded dice, but I want to talk more in depth about the loaded dice and deconstruct this trade or any trade or what. So I want to talk about what you're doing here. Okay, let's there's no stock and there's 3 options, but I'm going to make the options on the top row disappear. Okay, so when you're bullish on any stock, you can sell a put. In fact, what's the first step in the will? If any of you guys do the will, the first step in the will is to sell a put. Well, selling a put is a bullish move on a stock, but in the will, the plan is if the stock goes down, you end up buying it and then you sell calls, and that's cool. But selling a put is a tried and true way to do things that you're bullish on. So if a person was just bullish on QBTS, whatever this thing is, it's some quantum computing, who knows? Anyway, Doesn't even matter. It's evidently it's in play. It was at 5 a few days ago, so this may be a terrible trade. I have no idea. If you think this is going down, don't do this trade. This is for somebody that's bullish on this company. This is a way to express a bullish opinion. Not that it may not work out for you if it goes nowhere. That's how the trade's designed. It doesn't have to go way, way high, but it's going to have to at least be steady, or go up a little bit to, you wouldn't want to do this if you're bearish on this company. If you lose 50% of the value, no, this trade's not going to work out. But anyway, so here's the first step to always look at is just selling it at the money put. You can see the little hash mark there by 10. That's at the money. And the reason at the money puts usually go for the highest relative price. See, it's $2.45. That's a ton of money on it. $10. Think about that. That's 24%. It's like 20. If you're a bank, it's on $1,000. It's $240. It'd be like 24% interest for about 6 weeks. If you annualize that, it comes out to about, see that IV, it comes out to 168%. That's how IV works, pretty much in a broad sense. So anyway, what you're doing is instead of buying the stock, you're selling this put. And we'll just, hang on, I'm going to switch the quantity to 1. Okay, you're selling this put. I mean, that's at a minimum. That's the most basic move there. So you get in, the second you do that, you could get a $243 credit. But they would charge you margin, and the most you could lose is $800 on it. But anyway, that's step 1. All right. So, but wonder if you like that credit, but you didn't want to lose $800. You don't know anything about this company. You don't want to lose $800. It's too much money or whatever. So let's look at you could buy a put. That's what Jay does. It's called a caller. So, or when you include a put in an option trade, it's called a caller. Okay, hang on. Okay, so now you've modified this trade. You've made this trade where you can only, before you could risk what, $700. Now the max loss is $284. Because it's a small trade, they're going to charge you $500 margin. Don't worry about the margin. I mean, your max loss is $284. But yes, it's going to tie up $500 to do this trade. And the reason it ties up $500 to do the trade is that's the difference between the strike prices. That's your risk in that spread. So you bring in a credit of $216, but your risk is 5 points. So they're going to charge you 5 points margin, even though you really can't lose that much on this trade. Anyway, the thing about this is this option, this at the money 10 strike option was so expensive. When you sold it for $240, that's huge. Like that's 168 IV. Okay, well then you're hedging it by buying this 5 put. The 5 put is a slightly lower IV, so you pick up a little bit there, but mainly you're buying the 5 put just to cut off your losses. So you have the same trade, except you have a little bit smaller of a credit, but you also have a smaller loss possibility. Here's the old trade: $757 loss, $243 credit. We switched it to be a $216 credit on a $284 loss. Okay. So this is a great trade. This is pretty much what the profit and loss graph looks like in Alti right now. Jay does this same thing, except with stock also. He does something, but it has the same effect on profit loss. Cap downside, capped upside. It's a great trade. That's how a caller, that's the profit loss graph of a caller right there. There's different ways to do a caller. You can do it with stock and options, or you can do it with just options. This is a synthetic caller with just options. Okay, but the problem with callers are they're fully capped on the upside. Wonder if you're like, no, this thing burned me last week because I did a covered call, at 5, and I sold a covered call at 750, and now it's trading at 10, and I left points on the table. Okay, well, we can handle that too. So you have $216 to work with. This theory of these 3-legged risk reversals, or what I call loaded dice trades. So let's go look at this. So this option costs $1 to buy. So okay, so let's see what that gives us. Okay, we'll see, and that gives us a similar profit loss graph to yield max. What I've actually done here is I've combined the yield max and alti trades. We have the bottom of an alti trade, cap downside. We have the top of a yield max trade, full upside. It's the best of both worlds. But the most important thing is the income, this credit right here. That's the only reason. The credit and the buffer. You're doing that for the $114 credit and for the buffer. It has to drop under the break-even price of $8.86, which is 7.2% away from where the stock is. So you get $114 and a 7.2% head start if you put this trade on. The one I showed you guys today, not trying to make it more complicated, but you occasionally you can find an opportunity you can sell the puts just as a unit. That's called a put spread, and you're selling it, and it's because you're getting a credit. So I just put in 2 contracts. So now it's $432 credit on a $568 loss. Then on top of that, we're just going to add 1 call option. So this is like a ratio or whatever, but just a 2-to-1 ratio. But what that does is that gives you a huge credit. You get a $330 credit on $670 worth of risk. Your profit potential is infinite. Your chance of profit is 59%. And that you can also tell that because you have a go nowhere profit. Whenever you have a go nowhere profit where you don't need the market to move, but you have plenty of green territory right there, that also is a clue that you have a little edge in the trade, or that you're catching some theta decay in the trade. Doesn't guarantee you'll win. The market can still go down. Nothing you can do about that. All right. But anyway, there's worse trades out there than this. I don't like trades that go out this far, but this was the option. The reason we did this was, well, it was this. Let's look real quick. Then I'll talk about something else. But I just wanted to talk about that trade. I really like that style of trading. I'm going to talk more about those types of trades. It puts the best qualities of yield max and alti together in one trade. Plus, I don't like to have to own stock. You can be more diverse. If you have a small account like me, it's $20,000 or something, you can have on 10 trades, all with $1,000 risk easily, or $2,000 easily. Okay, and that's also why I like less expensive stocks also, because you can do it more efficiently. You still make the same money. 50% is 50%. 50% of $600 is the same thing as 50% of $6,000. So, all right. I look at this covered call option screener, and I look on it for interesting names, maybe something I hadn't heard of before, but also a good deal. I click on the flat. This is the go nowhere price. These trades have the biggest, to me, built-in edge, where you aren't counting on the stock getting called away to make a lot of money. So then I look at these and look, number 3 on this list, return a flat. You make a 10% return if the stock does nothing. That's huge. You have a potential return of 605%, or 74% in a month and a half, which turns into 605% annualized. You could do worse trades than this. We could also we'll probably look at QSI and Note tomorrow. Those looked a little too cheap. They can be too cheap also. I like the $10 to $20 range. Lots of times that's kind of a sweet spot. Look at it, but it's 35. It's trading at 18. It's just 35 strike options are out of freaking control. There's, Jasper Therapeutics. Who knows what this is? We're going to try to make money off the people YOLOing off it, but also YOLO it ourselves, but in a smart way. That's the whole idea to this. That's what Jay's trying to do on Alti, basically. It's a YOLO fund. I mean, it's a bunch of long shots trying to, going for yield. Let's look at it on JSPR. Let's look at it on here. It's taking too long to load that other thing. It was the 35 strike call. I was trying to look at the expiration. I think it said the 17th, which all right. So JSPR. Okay. So, okay. They don't have weekly option expirations. That's kind of a strike against them. Let's, I'm just going to add sell put. Just selling put's a good place to start on anything. Look at the selling at the money put. See what it's going for. It's bid at 490, asked at 670. It has some volume and open interest. This may not have been the best idea. Let's just for fun though. It's fun. Let's try to see if we could set up something. So we have a short put at the money, and then we add a buy put or a long put out of the money. However, far we put the strikes between the two puts is our risk. So if we did a 17.5 and a 10, our risk would be 7.5 per contract. So $750 per contract. Okay. Let's do it one at a time. Let's exclude the call. Let's just exclude everything. Okay. We could sell the at the money put by itself for $488 credit. Problem is you have a $3,000 loss possibility if you get stuck holding the bag, if this thing drops. And it could. So instead of the $488 credit, what can we do about that? We're going to include this other put. So now we included this buy put. This makes our profit and loss graph at expiration look like this. Well, we're going to drop the stock. We don't need the stock. Remove. Okay. That's our profit and loss graph at expiration. That looks like Alti. That's an Alti trade. That is synthetically equivalent to an Alti trade right there. And he'll probably have this in Alti next week. Who knows? I don't know. Jasper Therapeutics, he's had worse sounding stocks in there. So it's possibility. Look at the implied volatility. See that down there, 512? Are you serious? Look at this. So yeah, 533. Let's think about that. What does that actually mean? So this is a 17 and this asset's worth $1,700 and this is approximately worth 500. So that's 33%, 5, 10, 50. Yeah, it's a third or something, probably a little bit less than a third. Okay. That's in a week. So a third annualized over a week. Woo. Anyway. All right. So, but you could do something like that, and just that alone is a great trade, and there's nothing wrong with that. You bring it up. That's called selling a put spread. It's a great trade. You have limited loss on the downside. That, like I said, it's the distance between the strikes, 7.5 less the credit you received. You received $336 if you do this right away. So your risk is 336 less 750, which is only 414. So this puts you in a good trade. You have a go nowhere price. You just don't want this thing to drop more than 20%. Look at that break even right there, 20%. You need to stay above 1414. If you're a technical guy, you can look at the chart. I'm just talking math. I'm a math guy. I'm not worried about the chart. But yeah, look at the chart too. Pick one that's going to go up too, because that's part of it. I'm not going to tell you how to do that. I don't have any idea. So this would be a fine trade by itself. Well, let's include this. Let's see if we can make it better by including an out of the money call, or if we make it worse. Okay, well, just right off the bat, I mean, one thing, when you see a warning sign on the call right there, that means there's a wide price between the bid and the ask. Anyway, this may not have been the best one, but just for the sake of examples, we don't do this one in real life. But you could now what you're playing for is $100, and you just need the thing not to move more than 6.8%. It needs to stay above 1651. Okay, but here's what we're going to do. We're going to swing it a little bit. We're going to add we're going to make the puts 2, but we're going to keep the call 1. I do that a lot of the time. What that does, look, that gave this gives you a $435 credit on a loss of $1,000. So if someone had a $20,000 account, play money account, that's why I call it, but just for fun money, what I do is I break that up into 5% increments. So I don't lose more than 500 of that at a time. So this trade right here would be too big for me. I would do this, but I would just do 1 lot. But I'm trying to show you guys how to adjust the size. But if I'm helping someone that has a bigger account, they might do 2 lots. On 1 lot, though, yeah, the risk is good, but the reward's not as good, because part of the reward I was getting was from doubling the profit centers coming from selling these puts. And this is an expense over here. Now that I can't sell twice as many of these, even what I'm trying to say is, even if you want to sell twice as many of these, if you can't lose $1,000, don't sell twice. Look for another trade. There's thousands of companies out there. They all have options now. Lots of them are liquid. This wasn't a really good example, but anyway, that we'll just put that in. I mean, that's not the worst trade, but I liked it better like this. Someone put a gun to my head. That's a pretty good trade. You $336. You risk $400, but it has to drop. The stock has to drop 45% for you to realize that $400 loss, or at least more than 20% to start losing something. That's not a bad trade right there. I don't know if the extra call is necessary there, but depends, though. It depends on how bullish you are on the stock. If you're bullish on the stock, you can do that. But the only problem with this is it makes a big flat spot in the middle here where you only make $99. Well, that sucks, but that's the cost of doing that. However, there's a way to get around that too. The way to get around that too is you aren't going to hold this trade till expiration. You notice Jay never holds the trade till expiration. So that's how I figured this out. You hold it till about halfway. You have a profit and loss graph that looks just like stock. You don't have a flat spot. You got an income off the get-go. You don't have a flat spot. You have limited downside like Alti does, but you have unlimited upside like YieldMax does. So, you could do worse trades. This isn't the worst trade I've ever seen. Anyway, we'll just hit save trade. Let's see. Loaded dice. And you can also do bearish loaded dice trades. But you could also, this Jasper wouldn't be a bad will candidate. Well, you could call this is basically a will trade. The will starts with the sold put. This trade starts with the sold put. The will just waits till you get the stock to buy the call. This buys the call on the same time you sell the put. So that way, if the stock goes up off the get-go, you aren't screwed like you are in the will. I mean, you know what I'm saying? It doesn't mess you up. It doesn't ruin it doesn't make you mad. But what always happens to me is the stock I'll get assigned. The stock will go straight through the put strike. I'll get assigned, and then I won't be close enough to the call strike. But then inevitably, I'll end up selling calls that are under the. Before I knew how to do this, before I met Jay, I never thought about uncapping the upside. before I saw the covered call spread, I mean, I've read books and stuff, and I mean, I would, I don't know, but yeah, I've never thought about doing a covered call spread. It's a genius move. So anyway, I've just adapted Jay's strategy and made it for the small guy because you don't need stock.